Good afternoon or good morning, wherever you are, and welcome to our H1 2022 Food Commodities Market Outlook webinar. My name is Tosin Jack, and I am the Commodity Intelligence Manager at Mintec. And I have the pleasure of moderating today's very timely webinar. As most of you probably know, global food commodity prices skyrocketed and remained high in 2021, driven mainly by the continued effect of COVID-19, high production costs as a result of record high input costs, elevated freight costs, and all other types of associated costs. So, as we start 2022, we're here to present how prices are expected to shape up in some core food commodity markets. Before we go into the presentation, a few housekeeping points. If you have any questions, please post them under the Q&A section and we'll pick them up at the end of the presentation. We'll try to get, if we don't have enough time, we'll try to get through the questions, but if we don't have enough time, we will get back to you via email. We also have some documents on the handout section that you can take away. So you can look under the handout section to take away the document that we've put there. So moving on, today's presenters are Mintec's market analysts, Zanna, Rutika, Jose, and Alice. And they'll be taking us through the market updates and outlooks in their respective market categories. So yeah, here you can see the bio and who's speaking to you today. The agenda for today, we will start. So the presenters will begin by giving a category update, detailing the price drivers for these core markets that you can see on the screen in the last 6 months. So price updates for the last 6 months, and then they will provide a quantitative outlook for the representative or the benchmark prices of specific commodities for the first half of 2022. So to give you an example, Zanna will start with a grains category update. So she'll give you an update of what happened in the last 6 months. So H2 2021, how are we getting into 2022? And then she'll provide a quantitative wheat outlook for the first half of 2022. Then we'll move on to the following categories that you can see on the screen. So meat category with a beef outlook, and dairy, butter outlook, and vegetables. Lastly, we'll go on potatoes. So a deep dive of the outlooks for these markets. A very quick intro for those that are not familiar with Mintec. I think it's very important for you to see why Mintec is best placed to talk to you about everything we're going to present today. Mintec is the world's leading provider of commodity price data and insights. And on our world-class platform, which we term the Mintec Analytics platform, through this, we deliver access to more than 15,000 commodity price series. We have associated insights on this series, and we have more than 60 reliable commodity price forecasts with urgent recommendations. And the important thing or the unique thing is that you get all this in one place. So we're improving efficiency for you and also helping you to control your cost and manage your risks through our platform. So I will now pass over to Zanna to take us through the grain market insights. Over to you, Zanna.
Thank you, Tosin. Hi, everyone, and welcome to this presentation. I will start with the first slide, which is on Mintec Category Index for grains. This index is a blend of wheat, maize, and barley prices. On this chart, I'm showing both the European and US index. What we can see is that the both indexes have been trending downwards for a short period of time during Q3 2021, but were still higher year on year. In the Q4, the indexes resumed an upward trend, which has been mainly driven by COVID-induced high demand, some supply tightness in the corresponding markets, high freight rates, and other input costs. Now I will deep dive into one of the grain markets, which is wheat. So let's take a look in detail at what's happened to wheat prices in the second half of 2021. The first chart at the top shows the Euronext wheat price that it was trending higher in Q3. It was up 8% quarter on quarter at 229 euros per metric ton, and this was due to uncertainty around wheat availability following the poor weather conditions across Europe. There were some excessive rains in July that delayed the wheat harvest and led to grain quality concerns in France and Germany, and at the same time, high temperatures lowered yields in Poland and Northern Europe. In Q4, the Euronext wheat price was trending even higher. It was up 21% quarter-on-quarter at 282 euros per metric ton, and this reflected a tighter outlook in major wheat producing and exporting countries. These are US, Canada, and Russia. Also, the weakening of euro against the USD dollar provided additional support to wheat price. Then, in November, we can see that the Euronext wheat price reached a record high after Russia reiterated its intention to cut exports in 2022, while also announcing that it could overhaul export tax arrangements. Currently, the Russian Agriculture Ministry determines the size of the tax on a weekly basis, based on a formula where the tax is set at 70% of the difference between the reported market price and 200 USD dollars per ton. Then all the current supply chain disruptions and high prices of crude oil, gas, fertilizers, and freight also continue to support Euronext wheat price. For the bottom chart, the US wheat, so the seaboard wheat price, it also increased in Q3 by 4% quarter-on-quarter to 260 USD dollars per metric ton, and this was due to lower global production estimates by USDA. There was a slight price decline at the end of August due to slower export pace, which was caused by Hurricane Ido, which hit important grain terminals and damaged equipment along the US Gulf Coast. Then in Q4, the US wheat price continued to rise, and it was up 11% quarter-on-quarter at 290 USD dollars per metric ton. The price increase was attributed to tight supply in the US and Canada. Then, in November, we can see that the seaboard wheat price reached a 9-year high, and this was due to news of poor weather conditions in eastern Australia that led to fears of tight supplies in 2021 and 2022 season. In December, both wheat prices corrected downwards due to wider market selling off amid Omicron variant uncertainty. So now, let's move on to the next slide and talk about supply and demand fundamentals. So overall, the global 2021-2022 wheat production is projected to reach a new record, increasing for a third consecutive year to a total of 777.9 million tons. So if we look at the chart at the top, we can see that the significant supply growth is coming from the EU, Ukraine, and Argentina. The EU 2021-2022 production is forecast to increase by 9% to 13 million tons compared to the previous season, with a large production increases estimated for Bulgaria, Romania, and Czech Republic. Also in Ukraine, production is estimated to hit a record high this year. However, in Russia, there has been some adverse weather conditions that have reduced the winter wheat, and now the production is estimated to decrease by 12% to 75.5 million tons. Also, US and Canadian wheat production is forecast to decrease, mostly on reduced yields due to long-term dryness. In terms of the global wheat demand, it is estimated to reach a new record at 787 million tons, and this rise is mainly due to an increase in feed wheat and residual use. If we move now to the bottom, to the chart on the left-hand side, you can see how EU feed wheat consumption is surpassing last year's figure, and China's demand for feed and residual use is expected to fall by 10% year-on-year to 36 million tons, following a record consumption in the previous year at 14 million tons. So this fall is mainly because of increased maize availability in the market. Let's move now to the bottom right-hand side chart and see what the situation is like with the wheat stocks. So the global 2021-2022 ending stocks are expected to decrease by 4% year-on-year to 278 million tons, which is the lowest level since 2016-17 season, and the majority decrease is coming from US, Canada, Russia, and EU. If we look at the US stocks, they are projected to reach their lowest level in 14 years, at 16.2 million tons. This is down almost 13% year-on-year, and this is because of a smaller crop. The EU wheat market is also projected to be tight this year. Ending stocks are expected to fall by 9% year-on-year to a total of 10 million tons. Now let's move on to the next slide and look at the H1 2022 price outlook. So for the top chart, we expect that the Euronext wheat price will increase over the next 3 months, so in Q1, which is supported by lower production volumes in major exporting countries. As I mentioned before, these are Canada, US, and Russia. Even despite the expectation of larger supplies from Australia and Ukraine, broader market issues could lift grain prices in the next 3 months due to record high input costs and inflationary pressures that we're currently having. In addition, the new Omicron variant brings a lot of level of uncertainty to the market. Also, the expected increase in the EU exports and tight opening stocks should keep prices historically high. In addition to this, Russian government announced that it's considering introducing a grain export quota starting from 15th of February, and this could lead to further cuts in Russian wheat exports and reducing global availability and thus supporting prices. In Q2, we expect that the Euronext wheat price will decline slightly, which will offset the price increase in Q1. This decrease is a seasonal decline. We also expect that the input costs will start to soften. So the average price range of the 6 months outlook is somewhere in between 257 to 264 euros per metric ton. So for the bottom chart, the seabed wheat price, for that we also expect to increase over the next 3 months in Q1, which will be supported by lower yields due to adverse weather in US and Canada. The price will be further driven by lower domestic stocks. As I mentioned before, is the lowest level in 14 years. The high input costs are also driving prices upwards. Similarly to Euronext wheat, we expect that the seabed wheat price will start to ease in Q2 and offset the price increases in Q1. So the average price range of the 6 months outlook is somewhere in between 275 to 288 USD dollars per metric ton. I hope this was helpful and thank you very much for listening. I'll pass it on to Tosin.
Thank you, Zana. So Zana has shown us wheat prices will remain firm when you compare this to the 6 month average, the previous 6 month average. Although, so there'll be some ease in the second quarter of the year, prices will remain elevated, which then means that prices will be higher than the last 6 months average. This is not the best news for the meat category. As you know, Zana showed us, feed consumption is meant to increase, but with this high feed wheat prices or high grain prices generally, typically means high feed ingredient costs for the meat category. Also, what we've seen is that consumers move away from meat during recessions or slow down in economic growth. They either move to cheaper proteins or wheat products. So there's all these interactions between these two categories. However, with the right knowledge and insight, professionals in the meat supply chain can be properly prepared, even though we're talking about, elevated prices today. So I will pass on to Rutika to present the update on the meat category and outlook for beef. Over to you, Rutika.
Thank you, Tosin. Um, so, as Zana has rightly mentioned, that feed will be driving the prices. But before we go into how the prices would move, I would like to present on the global meat category index, which is there on the Mintec Analytics platform. And this meat category index, it comprises of pork, beef, chicken, lamb, and turkey. And as you can see on the Mintec Analytics graph, the prices they have shown increase in Q3 2021, and which was mainly driven by firm beef prices and lamb prices. The prices they remain overall elevated compared to Q2 2021 as well as Q3 2020. Apart from the firmness in the beef prices in the EU and US market, the beef prices also rose in Mexico, Canada, Argentina, and that's why we can see the index going upwards in Q3. Also, the lamb prices were impacted by drought-driven supply tightness in New Zealand market, and the freight costs were comparatively high, which led to stronger lamb prices. As you can see, a green arrow on the graph, which shows that the prices have declined in the later half of the Q3, where the prices went down because of the weakness in the pork market. So the pork prices, they mainly went down because of African swine fever in China, which took a toll on its import demand. So the Chinese market was flooded with the domestic pork, because the farmers, they had to do a mass culling of their hogs, which flooded the market, and it took a toll on the demand, its import demand, and that's why the prices, they started going down. However, in Q4 the prices started rising again, as you can see on the graph, with an increase in the poultry prices. The chicken prices were relatively high, because of the feed costs, as we have seen that the feed prices have been quite high since 2021. Also, beef supplies on the market, they remain tight during the same period, because of the Brazilian beef, because there was a ban on Brazilian beef, and Brazil is one of the largest exporters of beef, and there was a self-imposed ban in Argentina on beef, and this coincided with the high poultry prices, and that's why we can see that the index is went stronger in the Q4 2021. So because of this reason, I would be diving deep into the beef market, particularly the US and EU beef market, and analyze how the prices would move in the next 6 months. So as you can see on the Mintec Analytics graph, the US beef prices, they have been trending upwards in last 6 months, and it is mainly because of the persistent drought in the country, which led to an increase in cow slaughter rates at lower carcass weight, and which led to tighter supplies in the market. As Zana has mentioned before, the feed grain prices, they drove the overall feed cost upwards, leading to a firm of leading to firmness in the US beef prices. Also, beef exports in the US, they were dramatically up in 2021, which between January and October, the number says that they were up 20% year on year, which supported the prices further. Also, factors like COVID-19 related supply chain disruptions due to the infections in the meat processing workers, a seasonal rise in demand due to a Labor Day and grilling season in September and October, kept the prices up in H2 2021. Again, moving ahead with the Brazilian beef market, which is one of the largest exporter of beef, there was a downturn in the prices seen in H2 in Brazil, and it was mainly driven by mad cow disease in the country. Top importing markets like China, Saudi Arabia, and Egypt, they imposed a ban on Brazilian beef, and that's why the Brazilian market remained flooded with beef. Also, on the domestic end, the demand, it remained quite sluggish because of the economic downturn in the country. The beef consumers in the country, they switched to the cheaper sources of animal protein like chicken, which took a toll on the overall consumption of beef in Brazil. Similar to the US beef market, EU beef prices, they, as you see on the bottom graph, they have risen dramatically in H2 2021. And it was mainly driven by a recovery in the food service demand. Also, a beef production in Republic of Ireland, it dropped 7% in H1 2021, which and it was mainly influenced by Brexit related uncertainties, and this led to a supply tightness in H2 2021. Similar to the US beef market, high slaughterings at lower carcass weight were driven by feed costs, and processing disruptions due to COVID-19 infections led to the upward movement of prices. Looking into the supply demand side of the global beef market, it would help us evaluate how the prices would move in the next 6 months. So, the global beef production is expected to show a marginal rise, that is 1% year on year in 2022, to reach 58.1 million tons carcass weight equivalent. And as you can see on the graph or on the top, the chart graph on the top, the prices are mainly the production is mainly driven by an increase seen in Australia and Brazil, offsetting the declines in EU and US. On the trade front, as you can see on the bottom graph, the US beef supplies are likely to remain tight due to lower availability of slaughter ready cattle. Also, exports to destinations such as Japan and South Korea, who respectively account for 30 and 24% of the US beef exports, are likely to remain strong with a tariff reductions from these regions. So overall, considering the dynamics in the market, the US beef prices could remain strong, which we will see on the next slide. Um, also, in terms of the Asian market, wherein Australia is likely to come with larger volumes on the market, and there would be a severe competition scene over there. Um, um, uh, Favorable weather conditions in Australia, and they are likely to result in higher carcass weight. So, countries like US and EU might face more competition in the Australian market. But considering the relation between Australia and China, markets such as Brazil and US could be benefited more. So change in the trade flows could be seen. So moving ahead on the last stuff for the US for the meat market, it would be the outlook, and as considering all the factors we have mentioned before, US beef market is likely the prices in the beef. Uh, the prices in the US market for beef are likely to remain strong because of the weak supplies on the market, strong exports demand from South Korea and Japan, and also from Mexico. And as Anna mentioned before, high feed prices are expected across North America. Similarly, in the EU market, there could be a reduction in the EU beef production. So the again tight market supplies. Also, EU has developed a strong relation with Mexico, Vietnam, and South Korea. So this might boost exports from the overall EU region. And last but not the least, it is the feed prices from are expected to remain elevated because EU mainly imports wheat from other regions. Also, countries like Spain, they are dependent on all the feed grains. So this might increase the overall cost of production. So we would expect US beef prices to remain 3 to 8% high in next 6 months, and 1 to 4% high for EU beef prices. Thank you. Over to you, Tosin.
Thank you, Rutika. So we've just heard the impact of the high feed ingredient cost on the meat market and beef in particular. This is definitely something that's affected the dairy category and its market dynamics. So Jose will now walk us through the effect of this high feed cost or this high input cost on the dairy sector and other drivers as well, with an outlook on butter. So over to you, Jose.
Thanks, Tosin. Right, as Rutika has just mentioned, the cow slaughtering increase is directly affecting the milk output and consequently supporting dairy prices. Hello, everyone. I'm Jose Saiz, and today's presentation, I'm updating you what is happening in the dairy sector, particularly butter, and the market outlook for butter prices in the next 6 months. First, I'm going through the global Mintec Dairy Category Index, which gives us a representative picture of how dairy prices performed during 2021. Overall, we can see a significant price rise during 2021, hitting almost 40 points higher by the end of the year. We can clearly differentiate 3 periods throughout 2021. During the first quarter, there was a significant price rise during the cold winter in the European Union, causing a slowdown in the milk supply, combined with a spectacular Chinese demand for dairy products. These two factors fueled global dairy prices during the first quarter of the year. The last time we saw an important surge like this was in 2014, when Chinese demand pushed global dairy prices to new record highs. Chinese government has been promoting dairy as a way to improve health and boost COVID-19 immunity. Thus, Chinese consumers are associating dairy with well-being. While Chinese milk production grew by 7% in 2021, domestic consumption was up by 18%. As a result, China is filling this gap with dairy imports. As an average, if I'm wrong, yes, you can estimate that every 1% increase in Chinese imports drives about 1.5% in global dairy prices. During the second quarter, global dairy prices stabilized due to ample milk production in the North Hemisphere during the milk peak season in May. However, global dairy prices surged in the second semester of the year. Rising energy prices have boosted fertilizer prices. There was a direct correlation with feed prices, as my colleague Zanna has just mentioned, adding inflationary pressure on dairy prices. New Zealand was the main growth contributor during the last quarter of 2021, driven by a disappointing milk supply during the peak season in late November, and milk powders were high, which are high in energy intensive, faced the larger price rises. In the next slide, I'm doing a deep dive analysis of the recent price movements of the butter over the last 6 months. European Union prices skyrocketed in the fourth quarter of 2021. A large share of the rise happened in November. Buyers anticipated purchases ahead of the festive period due to a fall in butter output and uncertainty of butter inventories. Butter sales performed well in the food service channel, offsetting the year-on-year decline in the retail sales. Equally, U.S. butter prices tended higher during the fourth quarter of 2021. Demand outpaced supply. Thus, butter inventories declined for 5th consecutive month in November. During the second semester, there was a steady demand both in retail and food service sector. The latter held up relatively well with the new COVID-19 variants. Also, competitive U.S. prices in the global markets contributed to a growth in export sales, tightening U.S. butter supplies. Likewise, New Zealand butter prices experienced a rise during the fourth quarter of 2021. It was driven by disappointing milk supply during the peak season in late October, and additionally, farm labor was critically short. The dairy sector has had fewer workers coming to the country because of COVID-19 measures, increasing wages to compensate workers. This supported butter prices in New Zealand. In terms of fundamentals, the top left graph illustrates the largest worldwide butter producers. By far, European Union is the largest producer, but over the last 5 years, European Union is losing market share against the United States, which is increasing its milk output. We can also see that during 2020, both United States and European milk processors flow more milk to butter churns, since consumers bake it more at home during the lockdown months. However, in 2021, this trend has reversed. Milk processors have been channeling more milk to cheese vats. Milk processors prioritized cheese production in 2021, which offered the most stable returns of dairy commodities, supported by a rebound in demand from food service sector, solid exports, and strong whey demand from China. It's worth clarifying that whey is a byproduct from cheese production. Also, New Zealand milk processors have focused on cheese production and whole milk powder. Therefore, butter production has been declining over the last 5 years. However, New Zealand sector's largest cooperative is upsizing its plans to increase annual butter production by 42,000 tons, reaching full capacity in 2 years' time. It's worth mentioning that 95% of the butter produced in New Zealand is exported. So New Zealand prices are a great benchmark for international butter prices. European exports declined by 17% between January and October 2021, which accounted for around 12.5% of the total butter output. This decline is due to lower supplies to export and non-competitive prices in the global markets. The main export decline were seen for the UK due to a Brexit-related trade deal aftermath. However, competitive US butter prices boosted export sales, particularly in Canada, which was not affected by the port congestions in the west coast of the US. The top right graph illustrates the US butter inventories during the last 3 years. We can see that in 2021, the butter drawdown season had an early start, with the stocks falling by a larger than a typical month in both in July and August. Also, butter inventories fell for 5th consecutive month in November, indicating that demand outpaced supply. However, US butter inventories remain available for near-term commitments. In the next slide, I'm projecting the butter matter outlook for the US and European Union. Overall, dairy prices are expected to remain firm in the next 6 months. We have not seen these elevated prices since 2014, when premium dairy prices encouraged farmers to increase milk output, adding downward pressure on prices in the following milk output season, and consequently plummeting dairy prices in 2015. However, we are now in a completely different scenario. Farm expenses are soaring, squeezing farmers' margins, and labor is hard to find. This is driving the reduction of cow herd numbers, as my colleague Rutika has just mentioned, and consequently tightening milk supply. I projected this dynamic in the next 6 months and to continue, and I don't anticipate a flood of milk anytime soon. Therefore, milk production is expected to be lower than desired in the next 6 months, which is likely to prop up butter prices. European butter market is bullish in the next 6 months. Although futures markets are in backwardation from the actuals in December, the average prices during the first semester of 2022 are likely to grow between 2 and 7% versus the average prices during the second semester of 2021. This is definitely underpinned by a slow butter output. Then we will have to wait until the milk output season in May to see if this slowdown trend is reversed. Since the European Union is the largest dairy producer and exporter, European milk output during the milk peak season is the best barometer for global milk output and marks price trends during the second semester of the year. Likewise, the US butter prices in the first semester of 2022 are set to rise between 4 and 9% against the second semester of 2021. They are key performance indicators that showing us that milk supply and butter output is continuing to decline. First, low cow herd numbers are declining, lower milk yield per cow, and additionally, farmers are using less expensive feed. This means that milk is likely to have lower fat. So milk processors may need more volume of milk to produce the same amount of butter. So also steady domestic demand and strong export sales are supporting US butter prices during the first semester of 2022. Many thanks for listening, and now I'm passing on to my colleague Tosin.
Thank you very much, Jose. So, as we've heard all through so far, what the three presenters have actually really talked about, apart from the high input cost or high feed costs that I've been highlighting, it's also COVID-19, the uncertainty that this has caused, and the fact that it continues to underpin most commodity markets. For this next category that we're going to talk about, the fruit and veg category, which Alice will present on, it's been about consumer demand for immune boosting fruit and veg, when it comes to COVID-19, people trying to increase their immunity, and also the different levels of supply chain disruptions to get these commodities to consumers, right? Like, there's that boost in demand, and there's just been the disruptions on the back of COVID-19 as well. So Alice will be finishing up on this category with an outlook on the processing potato market, which has also faced high input costs. So over to you, Alice.
Thank you, Josen. Hi, everyone. So I'm going to be talking about the global potato market outlook, focusing on two key markets, so the US and the Northwest European potato growers, which consists of Belgium, Germany, France, and the Netherlands. I'll also be focusing on the processing potato market in particular. So firstly, I'm going to discuss a brief overview of the Global Vegetables Index over 2021. The graph here presents the global Mintec category index for onion, potatoes, lettuce, tomatoes, and carrots. As you can see in the second half of 2021, that from October, there was a large spike in prices, and this continued throughout Q4 of 2021. So the spike is attributed to various factors which all impacted vegetable markets. One key factor is COVID-19. So during the pandemic, retail demand for vegetables was firm across Europe and the US as consumers opted for healthier choices. Firm demand has had a bullish effect on the market, and we can see this contributed to a rise during the second half of 2021. In addition to this, lockdown restrictions and closed borders due to COVID-19 affected transportation, logistics, and the availability of migrant workers. In turn, this has led to higher production costs, which have directly impacted the price of many vegetables. Moreover, uncertainty surrounding the new Omicron variant and growing cases in December 2021 raised fears of further lockdowns. Border controls and travel restrictions are likely to hit export markets. As well as this, tighter domestic restrictions could damage out-of-home consumption figures, particularly from the food service sector, which is what we've seen since the start of the pandemic. And secondly, we have logistical disruption. So this is largely related to soaring shipping costs, which have resulted from a huge recovery in demand as lockdown restrictions eased. This led to a shortage of shipping containers and delays at port. So costs have remained high throughout the 2020 and 2021. This is a substantial driver for rising prices in many markets, particularly for those who rely heavily on imports and exports. Thirdly, as mentioned by the other analysts, rising input costs across the sector. I touched on this briefly from the impact of COVID-19, but the current challenges for many vegetable growers are rising labour, fuel and freight costs, which are driving production costs higher and thus translating into elevated vegetable prices. Also during the pandemic, the proportion of farm workers willing and able to work significantly declined due to health concerns. This forced many farmers to raise wages in an attempt to incentivize new workers. More specifically, in some markets, a shortage of long-haul truck drivers led to delays with deliveries throughout harvest for some farmers. This meant they were unable to transport their fresh produce. So even though it was there was high wastage because they couldn't transport it. This leads me on to my final point, which is tied to supply fundamentals. Some vegetable markets have experienced a decline in production in 2021. The global potato market was hit with declines forecast in the Northwest European potato growers region and the US, which I'll walk you through in the next slide. So potato prices. For the NEPG, I've used our Mintec benchmark price for the Netherlands. This is a free buy price for processing potatoes. You can see in the first graph, the average price rose by 81% to 143.5 euros per metric ton in the past 6 months, compared with the previous 6-month average. For potatoes in particular, COVID-19 has been the underpinning factor influencing prices. The ongoing uncertainty surrounding new variants, the effectiveness of vaccines, and the expectations of future restrictions. COVID impacted on sales of processed potato products and fresh potatoes in food service outlets and at home. Lockdown restrictions led to a rise in retail demand for fresh potatoes as more people were cooking from home. However, processing potatoes for frying saw a decline in demand from the hospitality sector. This is now largely recovered in the second half of 2021, which is a contributing factor to rising prices. In addition, production for the 2021 season has declined. In 2021, farmers in the EU were reluctant to plant large areas of potato due to losses in previous seasons during the pandemic and ongoing demand uncertainty. As a result, potato areas were smaller this season, and therefore we saw a decline in production, which is adding further pressure to prices. And finally, on the EU, a key driver both in the NEPG and US market, which is faced by many growers, is rising input costs. So this is important in the potato market because fertilizer prices make up a big proportion of the costs. Additionally, we have soaring energy costs, which are increasing the cost of storage for growers. In the second graph, you can see US prices. So we've used a representative price for US potatoes. As you can see, the price also rose, up 28% to $302.3 US per metric ton in the last 6 months, compared to the previous 6-month average. The price has been driven by declining production following a severe drought that hit key potato producing areas, including Idaho, which is the top producing state in the US. Excess heat causes a lack of soil moisture, which is a critical condition for the growth of potatoes. As a result, US growers have reported slightly lower yields and quality issues, which has impacted production. The upward trend in prices continued throughout harvest in September through to October and continued until the end of the year. Many growers have also faced logistical disruptions, most notably high shipping rates, as mentioned before. So from now, this could be exacerbated by further restrictions and requirements following the recent outbreak of the new variant Omicron. However, if no further restrictions are introduced globally, shipping rates could ease as demand levels off. And this would ease the pressure on prices, but for now, it's a bullish driver. I'm now going to look into some specific market fundamentals. So as you can see from graph 1, this is NEPG production. There's a forecast production decline in all 4 countries year on year in 2021. The steepest decline is expected in Germany, which is forecast to decline 9.3% year on year. Lower to average yields in the NEPG combined with smaller planting areas led to a decline in production. In addition to this, some adverse weather conditions led to quality issues, which further damaged production quantities later in harvest for some regions. As I mentioned, this decline in potato production is in line with the uncertainty around demand levels during the pandemic, so farmers have planted less. The total potato area for the EU 04 zone declined by 4.7% in 2021. There was a reduction in area in all 4 countries year on year, with Belgium experiencing the steepest decline. On the right-hand side, you can see US production. The US has also experienced a decline in expected production for 2021. Drought combined with excessive heat during summer damaged yields in key production states in the US. So the 2 top producing states, Idaho and Washington, both had a decline in production of 7% and 9% respectively. This impacted the supply available in the market and therefore drove prices up through the second half of 2021. Thirdly, we have usage and demand. So overall, potato usage continues to increase on the back of ongoing economic recovery from the pandemic, with food service demand gradually returning to pre-pandemic levels. Firm demand is expected to continue as well. Exports also seem to be recovering in the NEPG zone, and in September, fry exports reached the highest monthly level, up 14.8% year on year. This supports that demand is gradually recovering to pre-pandemic levels. Recovery has also been seen in the US market throughout 2021. However, recent high prices due to supply chain issues have limited exports towards the end of 2021. So the high processing potato price in the US comparative to the import price did lead to a rise in imports to a record high for the US in November, and they were up 19% year on year. This was an opportunity for Belgium, so imports from Belgium to the US rose 25.8% year on year in November. The final graph on this slide shows Dutch processing potato usage, which is a good representation for the NEPG zone. You can see from the graph that it's been high throughout 2021. So in September, usage increased by 21% month on month to 343,600 tons, and 7% higher than the same period in 2020. And this is the second highest level on record for September. Usage also maintained a high rate throughout the remainder of the year. So you can see on that October and November, it was also at a high rate. So now I'm going to look at the 6-month outlooks, what's going to happen from here. Currently, the 2022-23 crop is unknown, as planting won't commence this year until roughly March. So the current price and forecast is determined based on the known production levels, so the 2021 production, and the increased cost of production until next year's crop becomes clear. So what we do know now is that the cost of production are rising for growers, which is a key driver in the market. So elevated costs of fertilizers, transportation, and labor are likely to continue to drive potato prices higher in the outlook period. If these current supply chain disruptions are not resolved, manufacturers will inevitably continue passing these higher costs along the value chain, likely keeping the potato prices firm. High prices are likely to continue, therefore, in the next few months until there is more clarity on next year's crop levels. So overall, for the NEPG, you can see on graph 1, we are forecasting a rise of 5 to 10%. That's between 150.5 and 157.8 euros per metric ton. And for the US, the second graph, we're forecasting a rise of 3 to 8% between 311.4 and 326.5 US dollars per metric ton. Looking forward from here, weather ultimately plays the key role in crop determination from next year. If we have a dry year and there's a hit on yields, there's likely to be a greater shortage and therefore prices could rise again. If we have a wet year and good yields, prices are likely to decline and ease off. But for now, we know that there's tight supplies, firm demand, and rising costs, and these are expected to drive prices higher over the outlook. Thank you, everyone. I hope that was helpful.
Thank you very much, Alice. And thank you, everyone, for such valuable insights. And to everyone that's listened so far, we appreciate your presence. So, to bring it all together, in terms of the key takeaway and everything you've heard today. As you've heard, COVID-19 continues to cast a shadow over commodity markets. It's really there. So developments around COVID-19 and new variants evolving will be key to watch. But all other things being equal, we don't expect a significant price impact like we saw at the beginning of 2020. And this is because food businesses have shown their resilience, right? They've developed their buying strategies. They've made various amendments to cope with the impact of the virus so far. But what we expect to see is responsive changes to new social or travel restrictions impacting the tourism, food service sector, hospitality sectors generally. So that's where we'll see COVID-19 having an impact. Also, labor shortages, that's another area where people have to be off sick or move away. So the availability of labor will be key when it comes to COVID-19, and then just the general supply chain disruptions that have come on the back of the virus and the pandemic as a whole. Secondly, whilst we can already see some input prices reducing, like say gas prices already easing, energy prices at some point easing, input costs are expected to remain high across most food categories. And this is just because I know that historically we've been used to low prices. This is like way pre-pandemic, but now prices reached record highs, and it just means that it will take a little bit of time to really go back to those pre-pandemic levels. So they will remain elevated when it comes to input costs. So it's very critical to have access to independent data and insights to monitor your cost. You need to know where precisely, where your cost increases are coming from. And with this, you can use a cost model to do this. A cost model analysis on the Mintec Analytics platform can help you do this. And overall, it just helps you discuss objectively with your suppliers. So what I'm basically saying is not enough for you to just know about your specific markets. You really can't stay in there. You need to understand the market drivers of associated costs, such as packaging, freight costs, all those things, which we even saw like they underpinned commodity markets at the end of last year. So it's very important to stay on top of all these costs to see how it's affecting the markets that you're covering or that you're purchasing in. Lastly, various countries are reporting high inflation rates. It's very important to really understand macroeconomic factors, right? We're seeing consumer price indices increase, consumer price increase a lot. It's about inflation. Consumers are being hit. There's high energy cost, high fuel cost, and so what we're seeing now is that we're seeing various governments introducing monetary policies. So our latest macroeconomic reports, which we published today, focuses on how various governments have introduced different monetary policies to tackle inflation. So this is going to be a big thing, and so it's important to stay on top of what these policies are, geopolitics, currencies, interest rates, as they will all impact the global macroeconomy. Commodity prices tend to follow the trend of the macroeconomy, and so what we do at Mintec is that we provide a global PMI forecast. The reason we do this is that the PMI gives an earlier indication on how GDP will move. So simply put, we can get pre-warning on the economy from our PMI forecast. So it's something that you want to stay on top of, right? This is going to be the next big thing: is inflation, is consumers. What's the government intervention going to be? What's going to be the impact of all this high cost, all these high prices on consumers in the food service sector, even also in retail? So these are the things that we're going to watch out for, and it's very, very important. The macroeconomy will be able to give you a guidance on that, and help you prepare adequately. So that kind of overall brings us to the end and takes us to some questions. But I just want to remind you that you can look at the handout section. We've got some documents there for you to take away, that you can look at. And so we looking at time, we've got some minutes, so I can ask some of the questions. I'm just going to go through them. There's one for you, Zanna. Says, do you know if the sowing area for durum wheat will increase in Canada and North Dakota, autumn, spring to next harvest? So, Zanna. Okay, looks like Zanna. It's not. So I'll probably move on to the next one. I'm not sure if you're talking, Zanna. Can you? Yeah. Yeah.
Uh, Hi, thank you, Tosin. Yeah,
Yes, we can hear you, Zanna.
this is
It's
a very
breaking
good
up a bit, but
question.
we can hear you
I
for
believe
now.
there will
Yes,
be some sort
We
of
can hear you,
recovery to the
Zanna.
wheat market in Canada in the next season. Can you hear me? I think it's a very good question. I believe there will
Yes,
be
we can,
some
Zanna,
sort
if
of
you can hear us.
recovery to
Or
the
I
wheat
can
market
move
in
on to the
Canada in
next.
the
Looks
next
like
season.
Zanna is
As
having
we
some.
know,
She can't
that
hear us.
suffers a lot.
Okay, so I will try to move on to the next question while Zanna sorts out that she can't hear us. So I'll move on to the next one. So there's a question on when you report and talk EU. Um, when you report and talk EU, does this cover the UK? So at the moment, what we do, we are having connection issues, Zanna. Okay, so when you report and talk EU, does this cover the UK? At the moment, no. Most of our EU data is strictly Europe. But what we do in our reporting is that we do EU plus UK. So we always talk about the UK separately in all our reporting. So when we're talking about EU, we don't have that. Someone has asked if the presentation deck will be available. We will not be sharing this widely, but those people that have attended the webinar, you can see a replay of this webinar later on. So there's another question. So I'm walking through this very quickly because some of them I've answered. So this is for you, Rutika. It says, do you have any insight into the China pork herd
Um,
recovery?
yeah, actually, thank you, Tosin. And actually, this is a very interesting question because China,
Rutika?
Tosin, can you hear me? Tosin, can you hear me?
Yes, I
Tosin,
can.
can you? Okay. So,
I can
okay,
hear
this
you,
is a really
Rutika.
interesting question. Yeah. Actually, this is a very interesting question because China, it drives the overall dynamics of the global pork market. And uh, as we can see, there are a couple of indicators which indicate that there is a strong recovery expected in 2022 in the Chinese pork market. One is the estimate from USDA, which says that the swine number in China it's going to reach 645 million heads in 2022, which is a 5 years high, a 2.4% increase year on year, and 7% increase compared to the average of last 5 years. So this is one of the key indicators which indicate there is a strong recovery in China for the herds, hog herds. Secondly, the imports of grains. Market sources have been talking about this. My contacts in the Chinese market have also mentioned that China is importing a lot of grains, particularly soybean and corn, which shows that which is required for the herd rebuilding activity. So these two indicators can be considered as a top signal for us to know that the herd building activity in China has reached its pre-pandemic level. Thank you.
Thank you, Rutika. Thank you for that. Another question we've had a few questions around the veg oils. Just saying that we have outlooks for veg oils. We've not covered it here because we recently presented a webinar on it. So our marketing team will share that with you. So we'll ask the question specifically. So there's a question for Jose. Jose, you mentioned that the butter market saw the biggest increase in November. What was the main driver of this increase?
Hello everyone. Yes, it happened in November and then entered in plateau in December. And the main reason I think is purchases were a bit in panic in terms of there was uncertainty in the butter inventories
Okay.
and in the European
Okay.
Union, and some
Hopefully
butter
everyone can
producers
hear me.
only.
Um, I'm yeah.
Sorry, can you hear me now? Um, Uh, so as I said, there was uncertainty in the barter inventories, and that's made purchases to anticipate it by purchases in November. That was the main reason, and there was a peak in November. There is a plateau in plateau in December, and the futures markets are in backwardation. So it thinks that the butter prices are gonna ease, but as average prices during the first semester of 2022 are being higher than the second semester of 2021. That, I hope I replied to your question. Hello.
Thank you very much. Yeah, that's great. Thank you very much, Jose. I think we're having some technical faults, so I'm gonna have to end the question. Yeah, and also we're coming to the hour. So for those questions that we've not answered today, we will get back to you on them. But we would like to say thank you so very much for taking the time to listen to us today. And yeah, we'll get back to you on other questions and enjoy the rest of your day.